All right, let's get right into it. We hear so much about China's economy, and it usually boils down to one single official number. But today, we're going to peel that number back and take a hard look at the engine underneath. And what you're going to find is a totally different and, frankly, a much more important story. It all kicks off with this idea, this mirage of 5% growth. This is the number that makes headlines all over the world and shapes where billions of dollars in investment go. I mean, that's a pretty heavy statement, right? But it gets right to the heart of the problem. This number, 5, which is supposed to be a sign of strength, well, it might actually be hiding a really deep and growing weakness in China's whole economic model. 5%, this is the target that Beijing shouts from the rooftops. It's the number all the analysts plug into their models, and it's the figure investors are desperately clinging to. It's the official story. Steady, powerful growth, just chugging along. So you have to ask yourself, right? If 5% is the story they're telling on the surface, what's actually happening down in the foundations? What is this big headline number covering up? And that right there brings us to the real story. And it's not about GDP growth, it's about productivity. And this is where that whole official narrative just starts to completely fall apart. Okay, so this chart right here, this tells the real story. This is the secret ingredient to a country's long-term health. And spoiler, it's not headline GDP. This chart tracks something way more fundamental, a country's economic efficiency, what economists call total factor productivity, or TFP. And if you just look at China's line on that chart, wow, it tells a shocking story. So what exactly is TFP? Well, think of it like this. It's a measure of economic magic. It's not just about having more workers or building more factories. It's about how smart you are at putting all those things together. It's about innovation, it's about efficiency, it's about doing more with less. And in the long run, it is the only thing that truly matters for making a country richer. And here it is. This is the bombshell. If you look back at that chart, after this incredible boom in the 2000s, China's productivity growth in the 2010s just completely fell off a cliff. I mean, it didn't just slow down, it actually went negative. The economic engine literally started running in reverse. So the huge, obvious question is, how on earth did this happen? Let's do a little anatomy of this complete productivity stall. Why did all that economic magic just, vanish? Well, it wasn't just one single thing. It was a combination of some really powerful forces that basically brought the whole productivity engine to a grinding halt. We're going to break it down into 3 key reasons. First, the country was just putting its money and people in the wrong places. Second, a dangerous addiction to debt-fueled growth. And third, the simple fact that China hit the limits of playing catch-up. First up, misallocation. A healthy economy is kind of like a healthy forest. Old, unproductive trees die off, which makes room for new, strong ones to grow. But in China, inefficient, often state-owned companies are basically kept on life support. And the data here is just wild. The share of revenue coming from new, dynamic firms plummeted from about 70% to just 30% in just over a decade. The forest, it just stopped regenerating. The second reason? A massive addiction to debt. After the 2008 financial crisis, China just opened the floodgates of credit to keep those GDP numbers looking good. Money poured into ghost cities, bridges to nowhere, empty apartment buildings. It created activity, for sure, and it helped them hit that 5% target. But it was incredibly wasteful, creating very little actual long-term value and just dragging the whole country's efficiency down. And finally, the easy wins were gone. For decades, China got this massive productivity boost just by moving farmers into factories and by adopting technology from other countries. But by the 2010s, that well had pretty much run dry. Now, to grow, China needs to invent, not just copy. And that is a much, much harder game to play. So all these things start to add up to a much deeper, more systemic problem, because these aren't just economic symptoms. They're actually tied to the fundamental structure of the system itself. Now, it's really tempting to just draw a straight line here and say, oh, this is all about political tightening under Xi Jinping. But the truth is actually a little more complicated, and maybe even more concerning. I think one analysis put it perfectly. This isn't about one single event or crackdown. It's a slow bleed. The system has developed this kind of hardening of the arteries, making it less dynamic, less responsive, and just fundamentally less productive. And here's the real irony. The state's effort to control the economy for stability has actually choked off the very things it needs to be productive. When who you know matters more than what you produce, and when these huge, inefficient state companies are deemed too big to fail, you kill the dynamism that drives real sustainable growth. Now, a sharp-eyed person might look at that productivity chart and say, hey, wait a minute. Productivity also fell in the 1990s, and then it came roaring back. Why won't that just happen again? And that's a fantastic question. The answer gets to why this time it's just completely different. This slide is absolutely crucial. See, the drop back in the 90s? Those were the birth pains of reform, the temporary shock of moving away from a command economy. But the drop in the 2010s, that's not birth pains. That's the exhaustion of the model. The old way of growing is just finished. A rebound this time isn't guaranteed. It would require a kind of fundamental innovation and reform that so far seems to be off the table. So, let's pull all of this together. Because at the end of the day, what truly decides a country's future isn't its GDP target, it's its productivity. Let's look at this chart one last time because it really puts it all in perspective. Notice the USA's line. It just keeps steadily chugging along with those gains compounding year after year. Now look at Japan. Their productivity stalled out, and it led to their lost decades of stagnation. China's recent collapse looks a whole lot more like Japan's stall than America's steady climb. And that really is the bottom line. You can pump an economy full of debt. You can build brand new cities. You can set any growth target you want. But if your underlying efficiency, your productivity, isn't getting better, it's all just noise. Long-term prosperity? It's a story about productivity, period. And so we're left with this massive question. The old model of catch-up growth that powered China for decades is over. That 5% growth target is a mirage that's hiding a much deeper rot. The real challenge for China now is whether it can or even will reform its system to unleash the kind of innovation it needs for a new era of growth. Its entire economic future really depends on the answer.